innovation is evolving so quickly, we have to just listen and look at the tone changes that take place from one conversation to the next to understand how rapidly the world is going to change. We know that innovation in the equity markets, the public equity markets, not the private equity markets, has been ravaged in the last year. It's about a year that it has been ravaged. And Raul mentioned that when there is a change in expectations, and last year, as we were getting our vaccinations, the thought that the economy would open up and interest rates would go up, inflation would go up, but would be tamed. During the year, there was a change. The supply chain issues did not go away. And so this fear about what inflation and interest rates are going to do has gripped the market. First, it gripped the innovation space almost exclusively in a puzzling way. Now it seems to be affecting the market a little more broadly. And if anything, oil prices going up are an incredibly burdensome tax on the lowest socioeconomic demographic sectors in our economy. So I think the fears here are going to shift from rising interest rates and higher inflation potentially to recession, especially, and you've heard me on this before, because we see inventories piling up throughout the ecosystem. So innovation stocks in the public equity markets are down, I'm going to say broadly, 50 to 75% in the last year. I mean, that's as bad as it got during 08-09. Innovation solves problems. And you heard about a lot of the breakthroughs that are going to solve problems. We saw it last year with COVID, in the last 2 years, COVID. Innovation solved problems. We had tests and vaccines that no one dreamed we would have in the short time period that we got them. And it was all because of innovation. Now we have supply chain issues. We have labor shortages. We have the cost of capital going up. And we have automation of all kinds. And we have DeFi. And so we really do believe that the innovation in that we are researching is a wonderful complement to the traditional asset management oriented portfolios, the traditional growth and value portfolios that are benchmark sensitive. With innovation strategies is not only appropriate, but we think will be necessary. And I do want to talk a little bit about volatility here. Volatility has become the watchword. And as Brett said in his opening remarks, many people associate volatility with risk. Volatility is more associated with uncertainty. And when time horizons collapse, as they have within the last year, then the volatility does increase. We use volatility to our advantage. We concentrate towards our highest conviction names, and that tends to work out very well as we go through these corrections. I will say, as we go through these corrections, and in terms of the way we are being covered in the market. There are some unfortunate instances where journalists are using endpoint sensitivities, and they're kind of random, the time periods they're using, and really quite unfair. Inflation and interest rate risks seem to be priced in when you've had this kind of a correction. And the broader market has joined in as well. We do believe that innovation is on sale, and we do believe that it will be really important for investors to move toward the right side of change, given the amount of disruption that we do expect It's also very important to keep that 5-year investment time horizon. The difference between linear growth and exponential growth when you're talking about a 5-year period is enormous. And because Wright's Law gets us to, I think, to the right answer in terms of the exponential growth trajectories, the surprises are going to be enormous. As we're focusing on the 5 years, keep your eye on the prize. We realize it's been a very difficult market. We also do believe, and our conviction this past year actually has increased, that these exponential growth trajectories have been accelerated by COVID, and even more so now by the turmoil we're seeing in the labor markets, logistics, and in the financial market.